The first rule of investing is don't lose money. The second rule is never forget the first rule. Warren Buffett. Hey everyone, welcome back to the channel. Today we're diving deep into a legendary book that changed the way the world thinks about money. The Intelligent Investor by Benjamin Graham. This isn't just any book. It's a financial Bible for smart investing. Warren Buffett, one of the richest men in the world, calls it the best investment book ever written. Want to invest like Warren Buffett? By the end of this video, you'll know how to pick stocks wisely, protect your money, and apply the timeless principles from The Intelligent Investor, the book that shaped Buffett's entire investing career. Let's start with the man behind the book. Benjamin Graham was an economist, professor, and investor in the early 1900s. He saw people losing everything in the Great Depression and realized that people needed a safer, smarter way to invest. So he created the idea of value investing. He also mentored Warren Buffett, who says 85% of his investing style comes from Graham. So if you want to learn what made Buffett so successful, this is where you begin. Investing versus speculating. Graham starts by explaining something simple but powerful: the difference between investing and speculating. Investing means analyzing a business and buying its stock because you believe in its value and future. Speculating is like gambling, buying something because you hope it goes up, even if you don't understand it. Imagine you buy a restaurant because you love their food. You've seen the crowd, you've checked their profits, and you believe they'll grow. That's investing. Now imagine you hear someone say, "Buy this restaurant stock, it's going to explode," and you buy it without knowing anything. That's speculation. Graham says, if you don't know what you're doing, you're not investing. You're gambling. Mr. Market. This is one of the most famous ideas in the book. Imagine you have a business partner called Mr. Market. Every day he comes to you with an offer to buy your share of the business, but his moods are wild. Some days he's overly excited and offers you too much. Other days he's depressed and offers too little. Graham says the stock market behaves like Mr. Market: emotional, unpredictable, and often irrational. Earlier, stock markets were physical places where investors had to go in person or call your broker. Things move slower, but today the entire market is on our phones. We get updates every second, notifications, breaking news, expert opinions. It's all instant. People now make fast decisions, buy in fear, sell in panic, follow the crowd. It's like Mr. Market is shouting in your ear 24/7 now. Your job is not to listen to Mr. Market, but to take advantage of him. If he offers you a great price, you sell. If he's giving away valuable businesses for cheap, you buy. In 2020, during the COVID crash, people panicked. Prices fell like crazy. But smart investors saw Mr. Market acting irrational and bought good businesses at a discount. Later, they made huge profits when the market recovered. Warren Buffett says, "Be greedy when others are fearful, and fearful when others are greedy." Margin of safety. Here's a golden rule from the book: the margin of safety. It's like the airbags in your car, protection when things go wrong. Graham says only invest in a stock when its market price is much lower than its actual or intrinsic value. The difference between the intrinsic value and the current price is your margin of safety. It protects you from losses if your analysis is wrong. If a stock is worth 100 rupees, don't buy it at 100. Wait till it drops to 70 or 60. That way, even if you're slightly wrong, you won't lose everything. Let's say you think a small shoe company is worth 1,000 rupees per share, but instead of buying it at 1,000 rupees, you wait till it drops to 700. Even if the company hits a rough patch or the market crashes, your risk is lower. That's your margin of safety. It's like shopping during a sale. You get the same thing for less. Two types of investors. Graham says there are two kinds of intelligent investors: defensive and enterprising. Defensive investor wants things simple and safe. They invest in index funds, bonds, and big companies. Doesn't spend time analyzing stocks and just wants steady growth. Enterprising investor, willing to study and work hard. They pick individual stocks, looks for undervalued companies, and can take more risk. If you're busy with a job and don't want to think about the market, you might be a defensive investor. If you're passionate about business, read financial reports, and enjoy hunting for good deals, you're more enterprising. Both styles work. Just choose what fits your personality and time. Emotional discipline. One of the biggest lessons from Graham is that investing isn't just about numbers. It's about emotions. People lose money not because they bought bad stocks, but because they panic during market crashes or get greedy during booms. In 2008, the market crashed. The Nifty 50 crashed by over 50%. Many people sold in fear. But guess what? Those who stayed calm and held on made their money back, and more, in the next few years. Let's say you had invested 1 lakh rupees in the Nifty 50 index in March 2009, right near the bottom. If you simply held that investment and reinvested the dividends, by 2025, your money would have grown to around 6 lakh to 7 lakh rupees. That's a 6 to 7 times return over 16 years. So Graham teaches us, be rational when others are emotional. Don't follow the crowd and stick to your plan. That's how wealth is built. Stockage selection tips for defensive investors. Graham gives practical advice on how to pick stocks, especially for defensive investors. 1. Look for companies with strong fundamentals. The company should be profitable for at least the last 5 to 10 years. It should have stable earnings and pay regular dividends. The debt should not be too high. Ideally, debt should not be more than twice the equity. Pick companies that are big and well-known, the kind that have been around for decades. Big companies are usually more stable, have survived ups and downs, and are less likely to vanish overnight. The P/E ratio tells you how much you're paying for 1 rupee of the company's profit. Safe range, as per Graham. A P/E ratio under 15 is considered reasonable. A very high P/E means the stock may be overvalued, which can be risky if the company doesn't grow as expected. 2. The price you pay matters. Always seek a margin of safety. A stock may be great, but if it's overpriced, it's a bad investment. Calculate the intrinsic value of a stock and buy it only if the market price is much lower. Stick to businesses you understand and trust. 3. Avoid hot stocks and market hype. Don't chase trends or new companies that everyone is talking about. They often have high prices and big risks. 4. Diversify your portfolio. Don't put all your money into 1 or 2 stocks. A good investor spreads risk across 15 to 30 solid companies from different industries. 5. Stick to your strategy. Don't act emotionally. If a stock's price drops but fundamentals are strong, don't panic. Be patient. Let time and value work for you. Warren Buffett's takeaways. Warren Buffett took Graham's ideas and added his own twist. Graham said, buy cheap. Buffett says, buy great businesses at a fair price. Buffett looks for strong brands like Coca-Cola, loyal customers, simple business models, honest management. He also says, risk comes from not knowing what you're doing. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Here are a few common mistakes Graham warns against. Don't follow the crowd blindly. Don't buy stocks just because they're rising. Don't ignore the basics of a company. Don't let fear or greed guide you. Buying a stock because everyone on Twitter is hyping, it is not a strategy. You need to understand why you're buying and what it's worth. So what can you take from the intelligent investor? 1. Focus on value, not price. 2. Be patient. Investing is a long game. 3. Keep emotions out of your decisions. 4. Protect yourself with a margin of safety. 5. Decide whether you're a defensive or enterprising investor. 6. Stay curious. Stay disciplined. This book may have been written decades ago, but its lessons are timeless. If you follow just a few of these principles, you'll already be ahead of most investors. If you found this helpful, hit the like button, share it with your friends, and don't forget to subscribe, because more book breakdowns, financial wisdom, and smart content is coming your way.